Good afternoon, everyone. My name is Ann Dalton, and I am the chair of the ADR practice section, and we are recording this for our YouTube channel. So if there are people that you know of that are interested in watching this particular session and are unable to attend this Zoom call, please let them know that Peter's fantastic presentation will be available on the YouTube channel, the Leaf Bar YouTube channel. And that leads me directly into introducing Peter. Peter Nyes is an amazingly accomplished guy. And no, I do not say that about everyone who I can drag into these practice section CLEs. Peter has a bachelor's degree in cardiopulmonary science, and then another bachelor's in history, a master's in history, and a master, well, of course, a JD, and a Master of Laws in Estate Planning. He is the co-chair of the Real Property, Probate, and Trust Law section of the Lee County Bar Association, and he puts on absolutely fantastic CLEs as part of his duties for that section. In addition to that, he serves on the board of the Lee County Bar Association. So I think Peter's one of those people that just never sleeps. His presentation today is General Tax Rules for Mediators 101. And I'm going to stop talking so he can jump right into telling us all about it. Thank you, Peter.
Thanks, Ann. Such a pleasure and an honor to be speaking to all of you today. I see some familiar names there, and to those I don't recognize, welcome, and I'm glad you could make it today. Ann asked us to pick a topic that probably doesn't get covered a lot, and we decided that perhaps talking about taxes and mediation would be good for our group. And so we put together this, it's going to be scattered because there's so many different topics that we could cover. And so we've tried to do the best we can. And we're going to move through a lot of difficult material quickly, but please know that I'm always available should you have any questions on any of this stuff, and we'll open it up for questions at the end. We're going to talk about some complicated things. We're going to need to take a break. Every time we see this slide, we'll take a break and take a deep breath and get our thoughts in order before we move on to the next subject matter. With that said, we'll get started with the great Samuel Clemens, who's also known as nom de guerre as Mark Twain. And he famously said, some people get an education without going to college and the rest get it after they get out. I love that quote. And in the spirit of Mark Twain, we'll teach you some things now that we're out of college that might be helpful for you to know. When I was trying to figure out what we should talk about when it comes to taxes, it was difficult to pick specific things. The tax code is about 3.1 million words. It's gigantic. And of course, we can't cover everything. So in putting together an agenda, these are the things that we're going to try to get through today. We'll talk really quickly about taxes and mediation, just give you some general rules. Then I think a lot of you are dealing in the divorce realm. So I thought we would spend some time talking about taxes and divorce. We'll cover the innocent spouse rule and the abandoned spouse rule, very important. We'll talk about transfers between spouses, I think, and individuals. Those are important rules for you to understand. Allocating income and deductions between spouses, very important, as well as the child tax credits. So we'll cover that quickly. Cancellation of debt income. It's something that a lot of us don't understand, but it's so critical to think about that topic when you're dealing with mediation, especially between parties. Retirement plans, those can get tricky. We'll cover that quickly. If we get some time, we'll try to cover the sale of the primary residence, specifically in the context of a divorce. And then at the end, if we have time, we'll try to cover family limited partnerships, LLC interest, and the tax rules associated with that. To get started, though, I think it's so important. It's critical to understand the tax ramifications to a settlement process. There's consequences to these things. And if you're not taking those into consideration, you're not doing a very good job, either as a mediator or trying to guide the clients and the parties in the right direction. So it's important to understand that some settlements and verdicts, they are taxable, some aren't. And we'll go over those rules really quickly. I understand that none of us are professional tax advisors, but that doesn't mean that we can't get those clients to get some tax advice, maybe before the mediation or after the mediation. And I'm just going to take a tangent and talk about when in mediation should you talk about the tax ramifications and consequences. Well, oftentimes a lot of professional mediators, they'll say, talk about that after you close the material interest of the deal. So, if you've got some kind of big split between partners, get that done, then bring up the taxes, because you do need the roadmap set before you could even talk about the consequences of the taxes. So possibly at the end, but something very important to keep in mind. It's important to understand that when parties negotiate the allocation of not only settlement payments, am I getting money lump sum or am I getting it over the next 10 years? But tax withholdings, that's important to understand. Should the party withhold 10% or 20% of the tax? And reporting, should it be reported on a W-2 if you're negotiating with an employer, or is it a 1099 issue? Generally, those will be respected by the IRS. But it's important to understand that the IRS isn't bound by the settlement process or settlement agreement. So although the parties may come to an agreement, the IRS should recognize it, but if it's something egregious and it's challenged, the IRS isn't bound by it. So that's important. Well, let's start with Rule 104, and that's really the IRC Rule 104 is where we see when we're dealing with mediation and settlement agreements, what's taxable. And basically what the IRS has said under the Small Business and Job Protection Act that was amended in 94, I believe, it said, generally settlement proceeds will be taxable unless it's, quote, on account of a personal physical injury or physical sickness. So if it has to do with a physical injury or a physical sickness, it is not taxable income to the parties. If it's anything other than that, it's generally going to be taxable income. So again, if it's associated with personal injuries, it's taxable, not taxable. All others are taxable. What would that mean? Tort, employment rules. So emotional distress. It could even be a sexual or assault without touching. That could fall under the taxable income rather than the non-taxable. And so one of the jobs of a good litigator or a mediator is to try to get the settlement payment maybe to be considered a physical injury, or a larger portion of it to be considered a physical injury, and thereby it not being taxable to the party. Let's jump into divorce really quickly. It's so important to understand that divorce does not relieve a spouse from tax liability. Okay, it's so important to understand. Sometimes we just think, hey, I'm divorced, I'm not responsible for anything, but that's not the case. Each spouse that files a joint return, they're jointly and severally liable for the tax liability. Okay, so it's important for us to think about when we're in the process of a divorce, do we have to sign a joint return? What protections do we have? Are we liable if we sign a return and maybe we didn't know exactly what we were signing because one of the spouses was not being fully honest or disclosing all the material facts? And it's important to keep this rule in mind. The IRS can randomly audit any return after 3 years. So generally the statute of limitation is run, but they could audit it. And if they find some cause, they can go and audit it up to 7 years. So let's take a party that's been divorced for 6 years. The audit comes on the 6th or 7th year, the spouse could have an issue. And if there's any kind of fraud involved, the IRS can go back and there's no unlimited amount of time. There is no statute of limitation. So I think it's so important when you're in a mediation, you always want to consider the possible tax debts. And that's not just the interest and the penalties, but the tax itself. The possible tax debts that are assessed in the future on a tax return that was filed in the prior years. So perhaps it's good to really take a look at those tax returns, do a deep dive into them and see if there's anything that looks fishy. And if there is, maybe negotiate that in your settlement process. Last general rule I want to remind everyone is that, hey, bankruptcy does discharge taxes, but not all taxes. Bankruptcy doesn't discharge taxes that are 3 years or less. And more importantly, bankruptcy doesn't discharge the non-filing spouse from tax liability. So if you had a spouse that filed bankruptcy individually and the other spouse doesn't file, that spouse is probably not going to care about the tax liability in a mediation, but the other spouse should be very mindful of that. So do keep that in mind as we talk. When we're married, we can only file one of 3 filing status. We either have to file married filing jointly, or MFJ, married filing separately, MFS, and then head of household. So those are our only 3 options when we're married, what kind of return we can file. Head of household, your best rate is really the married filing jointly. I think we all know that. Then head of household is better than filing separately, married filing separately. Married filing separately is going to have the worst tax rates or the least favorable to the taxpayer. So those are our three, and that's going to be important as we look forward on our status of our filing. Here's some general rules that I put in there. We're not going to cover these, but I put down how you can file for these types of things. And I want to also show you our current 2022 tax brackets. We see we have 7 tax brackets. We run from 10 to 37. And these are the 3 of the 5, but these are the important things on divorce or on marriage. If you're doing a prenup, we're either moving from the single individual filing status into the married filing jointly, or from the head of household into married filing jointly, or conversely, we're moving off the married filing jointly and into the single or into the household. We can all take a look at where we fall on this to make ourselves feel better about ourselves. I always feel disappointed when I see I'm still at the 10% tax bracket. I got to get my wife to work a little harder. Okay, it's important to understand this next rule. The marital status for federal income tax filing purposes, it ceases when the final decree is entered. Okay, so we are considered married until the decree is entered, that date, or there's a legal separation and it's signed by a court. There's a separation document, or the taxpayer qualifies for the abandoned spouse. Other than that, they have to file the joint like we talked about. And this rule is important to understand that if we got divorced, the decree was entered on the very last day of the tax year on 12/31, the couple is considered divorced for the entire tax year. Take that and go with what happens if this divorce decree came in 1 day later on 1/1 of 2022. Well, that couple has to file a joint return or head of household or abandoned spouse for the entire 2021 tax year. So it's important that we understand that we don't have to file that joint return depending on when that decree is entered, okay? Innocent spouse. This is an important thing to understand for clients, that perhaps they filed a return, it's the proverbial business partner spouse and then the housekeeper or the housekeeper. And she doesn't understand the taxes and she signs the return and she didn't know what she signed. Well, there's relief for that person. There's relief under 6015B, and we're going to look at the C rule, but this is the B rule. And the B rule says if they filed and it was a joint filing was filed and there was an understatement, okay, that was attributable to an erroneous item of one of the individuals, because it doesn't make sense to have an innocent spouse if they both had the erroneous understatement associated to them. But if one of the individuals had the erroneous understatement, then the other individual, the innocent spouse, she can establish that she had no reason to know that there was an understatement. And it's, the Court of Chancery, taking into account all the facts and circumstances, is inequitable to hold that innocent spouse liable. And then finally, it's filed, the innocent spouse relief is filed within 2 years of collection, not 2 years of when you file the return or 2 years of when after the divorce, but 2 years into the collection, she can seek that or he can seek that relief. And the relief that is granted is that the innocent spouse will be relieved of that understatement to the extent that such liability wasn't associated with the innocent spouse in that tax year. So very important. It's a form that is filed and the CPA can help with that. There's another innocent spouse rule though, and we find that under the same section, 6015, but it's subsection C. And this one now is where this is an example of you've been divorced for 5 years and now the audit comes in. And so you're no longer married, but you should still be able to provide for the innocent spouse relief. B, you were married and there was a joint return. C, you're no longer married, as we see in subsection A here. You're no longer married to the non-electing spouse. The electing spouse was not a member of the same household within the last 12 months. So you can't live together claiming this. Again, you see that same rule. The election was made within 2 years after collection, not after filing or after divorce. There was no fraudulent scheme between the parties, and the electing spouse had no knowledge. And again, it's just inequitable. And if that's the case, then the relief that the IRS could grant is that as though the individuals filed separately. And so if the tax associated isn't allocated to that innocent quote unquote spouse, then he or she's not going to have that liability associated with her. Again, it's done by a form, not too difficult. You just have to meet these elements. Abandoned spouse. This is another one I want you to understand. It's important to grasp that perhaps someone's just taken off and left the spouse behind, and they don't even feel comfortable. How could they file a joint return? They couldn't, because both need to sign. So they could just file an abandoned spouse claim. And in the abandoned spouse, we find in a different subsection or code 7703B specifically. And it's where the abandoned spouse pays more. It's almost the head of household, as we'll see, pays more than half to maintain her household or his household. They file a separate tax return, probably under the abandoned spouse. They're going to go ahead and just file it, or it could be head of household. The individual's household is their principal residence, and they have a dependent child that they can make the dependency claim on, that we'll talk about in a bit. Even if they don't make the dependency claim, you've really got to have that child, that dependent child with you living in your house. And again, you haven't lived, the individual lives in the residence separate from that spouse for the last 6 months. If you qualify for those, you can qualify for abandoned spouse, and then that allows you to do one of two things. You can either file single or head of household. And depending on where your tax bracket falls, you'll pick one or the other. You'll find that in single and head of household, if you look at that chart that I provided all of you, that they're the same rates until you get, I believe, above the 24% tax bracket. I'm sorry, they're separate rates until you get above the 24% tax bracket, then they're the exact same. So eventually, an individual taxpayer, if they're making more than $170,000, they're going to have the same rate whether they file single or head of household. So good to understand abandoned spouse rules. Finally, before we take our first break, head of household. Why would they want to file head of household? Because they are mandated to file one of the three, joint filing, married filing jointly, married filing single, or head of household. To file head of household or qualify for head of household, generally you're going to find that the taxpayers, they're not married anymore, or they're legally separated under a separation agreement, or they don't live with that spouse any longer, at least for the last 6 months. That the taxpayer still maintains more than half of their costs for their living, and that they have that child that qualifies as dependent. And that child lives with them for at least 1/2 of the year. So you see the same elements as you do the abandoned spouse. So oftentimes when they file the abandoned spouse relief, you're also going to file head of household because they qualify. Whew, that was a lot. We'll take a break for a second. I'm glad you're all, some are still here with us.
This is fantastic, Peter. Thank you so much.
We're moving quickly. And that was just kind of, let's get our feel around what kind of filing status, what are the rates, what are the rules on filing, and what are the relief. Now let's jump into some substantive tax issues and start to take a look at those rules. I want to talk about the income tax treatment of spousal support. We all know spousal support. It's alimony, it's child support and things. And when Trump came in office in 2017, they made a big tax push, and they passed what was called the Tax Cut and Jobs Act. And that Tax Cut and Jobs Act was passed through the reconciliation process, which means it had to be budget neutral, but it also means that it had to phase out over time. So we now are under a new tax regime that will last from 2018 until 2025. So the rules that we're going to talk about, they could sunset in 2025, but we're going to talk about what we're under now, which is under the TCJA. And the TCJA basically said that spousal support is no longer deductible on the payor. Okay, so it used to be when the payor made a payment of spousal support, they got a deduction for it. But after 1/1 of 2019, they no longer get the deduction. In addition, when the recipient received that spousal support or that alimony, they had to include it as gross income, and they no longer have to do that. So it kind of netted itself out. However, child support is still not deductible, okay? And it's also not included in income, but these rules sunset, as I said, on 12/31 of 2025. But here's the current rule right now: spousal support not deductible, and alimony not included in income. So that's an important rule to understand. When we are dealing with parties and they are going to transfer assets between each other, the IRS will say, well, that's subject to what they call sale and exchange treatment. So if I meet Ann and I say, Ann, I want to give you this car, or we're going to exchange this car, it's going to be under this rule that we find under IRC 1001. And that's the transfer of property between individuals. And that rule says that gain or loss will be recognized on the transfer in that tax year. Okay, so that's our general rule. That it's odd that I would just give a car to Ann and she wouldn't give something back to me, and we would need to establish that it was a gift. If not, the IRS is going to say it's a exchange, and that Ann or I or both of us will have to report gain and loss.
Does my unending respect and affection count as consideration, Peter?
Yes, which would probably fall under non-physical, so that is also taxable income. What is income? Income is where we have our cost basis. If I buy a stock for $100 and I sell it for $101, we all know that I've earned $1 in gain. And that's because we know that that $100 had a value, had a reason. They call it a cost basis or our adjusted cost basis. So when we buy something and we get back the basis, we don't pay tax on that. There's no gain. But that $1, that was gain. So it's important that you figure out the basis of all the assets that you're dealing with in mediation so that you can see if there's a gain or if there's a loss. So we know that there's a gain if the proceeds that we receive back from the sale or exchange are greater than our adjusted basis. And we know that there's a loss if we get something lower than the basis, okay? So those are the two rules, but there's 5 questions that we always need to ask ourselves. What is the amount realized? And we figure that out again by figuring out what our adjusted basis is. And then did we make profit on it or did we make a loss? And is that gain or loss recognized? Sometimes gain or loss are not recognized. For instance, if I make a trade within an IRA, that's not recognized for income tax purposes because it's inside a qualified plan. You want to look to see if the qualified gain or loss provisions apply, because you can offset long-term gains and short-term and long-term losses, and they net each other out. And then you want to think about depreciation recapture. We're not really going to talk a lot about that, but these are the 5 questions that I always go through in my mind when I'm looking at a tax issue to try to start to begin to process how we can bite this large apple into little pieces. So, sale and exchange for individuals that aren't related to each other. That's not the rule for spouses, though. There's an exception to the 1001 rule, and we find that under the 1041 rule. And it's a non-recognition rule. And it basically says, listen, if you're married, you're not going to have to recognize gain or loss on the exchange or transfer of property between you and your spouse. Important rule. We all know this rule. We're just not really clear on that rule. But there's no gain or loss recognized when I give my spouse something or she gives me something, okay? And it doesn't matter if you're contemplating divorce. If you are contemplating divorce, you can load up all of your planning and get things done and avoid a lot of taxable gain or taxable losses by properly planning how you want to structure your settlement agreements. It's important to know when you do make a transfer, whether it's to an individual or to your spouse, the transferee's cost basis is the same as the transferor's basis. And that's under 1012. That's our cost basis rules under the IRC code. And the holding period, is it short-term or is it long-term gain? Remember, short-term gain, that's ordinary income to us. Long-term gain is under a preferable long-term gain tax rates, which are 15 and 20%. So it transfers the gain, the cost basis in your holding period. The non-recognition rule is very broad. It covers gifts, it covers sales, it covers divisions of marital property. So here you are going into a divorce and you're doing some marital property divisions. There's not going to be any tax associated with those divisions. 2 exceptions to this rule. 1, if your spouse is a non-resident alien. Why is that an exception? Because if she's living in Germany, the IRS doesn't want you giving her $20 million free of tax. So there is limits for non-resident alien. And then transfer of services. if you're giving your spouse a lot of money and you say, hey, I'm a pool cleaner and I'm going to clean her pool, that's not going to be allowed. So those are the only two exceptions. They generally don't come into play. So you have the non-recognition rule of transfers between spouses. How about former spouses? We've now got our divorce decree. We're filing now single. What about gain or loss recognition with former spouses? Well, that's still allowed, okay? But the rule's a little tighter. The transfer of the property has to be incident to divorce, meaning it's probably in the divorce decree. But here's the first sub rule. One, it has to occur within 1 year after the divorce. So you can't wait a long time. You really need to get these things done 1 year after the divorce to avoid the 1001 gain or loss transfer rule and to qualify under the 1041 non-recognition rule, okay? So within 1 year, or the transfers pursuant to a divorce decree, but this is a two-part rule, and the transfer has not occurred in less than 6 years from the divorce. So this would be something where it was in the decree, but he just wouldn't do it. You finally get him to do it. It's not going to be considered under the 1001 rule. Okay, so that's a two-part rule, important to remember. Finally, interesting, annulments. Spouses can still get non-recognition for annulment. So from the IRS perspective, you technically were married. It's unequitable to cause you to have the gain and loss between individuals, and they'll allow those couples to qualify under the non-recognition rule. So transfers between spouses, important. Let's just talk about three big things that I think a lot of you guys see. You know, what happens if the spouse is going to give the other spouse the life insurance policy? Well, one, it's not going to be taxable for gain or loss under the 1041 non-recognition rule. But remember too that proceeds received from a life insurance are not taxable. And we see that under rule 101. So if I get $100 million life insurance policy on a date of death value, and my wife gets that, no taxable event to her at all. It's all principal and not taxable under 101. If I exchange that policy to her in our divorce or incident divorce, not taxable. How about annuities? The assignment is non-taxable, again, under your 1041 because it's between spouses or former spouses. And the portion that each annuity payment is excluded from the recipient's income, just like it was under the transferor's receipt. Remember, when I do an annuity, I'm getting back 90% of my principal and only 10% is like a gain. So I shouldn't have to pay ordinary income for the entire check that comes to me. I only report that small amount of gain. So transfers, annuities. The last thing, interesting rule on bonds, United States bonds. If US bonds are transferred incident to divorce, the transferor, they have to include the accrued interest on their tax return when they reissue the bonds, okay? So they have to include the interest on their return when they reissue the bonds, but when the bonds are redeemed, that recipient spouse, she's gonna get it, or he's gonna get a 1099, and they're gonna have to report that on their 1040. The big rule, or the big interesting thing in this space about transfers between spouses are, when did that transfer occur? Did that spouse actually transfer that property? And there's two rules. The first one is it'll be considered transferred when the title is signed, so when the deed is done. But oftentimes, maybe they didn't do the deed for some various reason. And the second rule is when there's a shift in the benefits and the burden. And there's a famous case called Grote and McKay Realty against Commissioner. And they basically said, listen, if the burden is shifted over to that new taxpayer, they have the right to live in that house. They are supposed to pay the taxes and the insurance, and they're liable for the risk of loss. Then we can consider that the transfer has occurred on that date. Why is that important? Because you need to know what tax year it was the transfer occurred for tax purposes. Remember, you got a 1-year rule on former spouses. So eventually you can just say, listen, it's transferred for tax purposes under the benefits and burdens test. So important to keep in mind. Let's say we are in the process of a divorce and we're looking at dividing the assets up. It's important for us to think about What are the tax ramifications to that life insurance policy? What are the tax implications of the annuity? What are the tax implications of the primary residence that has all this trapped in gain? Maybe we should allocate those in a way that could be tax efficient. For instance, sometimes it's good to maybe give, for instance, a low cost basis asset to the spouse that doesn't make a lot of money because they'll end up paying less tax on that. And maybe the high tax earning surgeon spouse, maybe we should give him the assets with the least appreciation because he's going to be at the higher tax bracket. So we call that the high cost basis assets. And remember that when we're making these plans and we're moving this asset into that spouse's column and the other asset into the other spouse's ledger, that none of that is taxable. So good planning could help both spouses over time. Let's talk about income and deductions between spouses. Okay, first, that is governed by the state that we live in. I know that seems crazy, but how can the federal income tax rules be associated by the state that we live in? Well, it basically has to do if you live in a community property state or a separate property state. So you have to figure that out. We live in a separate property state, as all of you know. Sometimes we have clients that are coming from a community property state, but if we live in a separate property state, we look at the rules of that separate property state or equitable distribution states. And the rule in this state or in equitable distribution states is that the earned income, the W-2 income, that's taxable to the person who earned it. So in a mediation setting, it's not proper if this one spouse had W-2 income to try to allocate the tax burden to the non-W-2 earning spouse, okay? So that W-2 income, that really needs to be allocated over to that tax payer. And the income from property, well, that's taxed to the owner in accordance to their ownership interest. And we're going to look at that in a second, but under the state law, if they're 50-50, the income should be allocated between the two or the losses between the two of them. If you're in a community property state, the rule is different. Each spouse reports half. So if you have one W-2 tax earner and the other one doesn't work, she's got to report half, okay? There are some exceptions to that community property rule, and we're going to look at both of them right now. We find them under 66A and 66C. A tells us, listen, if the community property couple, they've been separated, they live apart for the whole tax year, they don't file a joint return because they're planning on getting divorced for the last 10 years, and she's filing head of household and he's not. And no portion of that community income was transferred between the spouses. You can escape the community property share rule and get into the equitable division property rule, which is that income should be allocated to the W-2 earner. So that's an important rule to understand, that we can escape the community property rule, but you've got to fit under those elements. And there's additional relief we find under 66C. And that relief is when sometimes the one taxpayer does the return and the other taxpayer doesn't really know it's done, and he allocates his community property over to her share, trying to give her the burden and pay the taxes. If that's the case, that innocent spouse is a bad word to use, but that spouse, they can seek relief. And in that scenario, there's 4 elements. It's a joint return was filed. The income was not included on that earned spouse's ledger. The spouse can prove they had no knowledge that it was done, and the spouse must be able to establish it's inequitable by the facts and circumstances. And your chancery, again, for equitable rulings is that the deficiency will be placed back on that community property spouse that had the W-2 income. So 2 exceptions to those rules, important to know. We probably don't see them a lot here in our jurisdictions. How about the estimated tax payments? Can we allocate those to different parties? Yes. They can be allocated as the parties determine. So if the husband says, I'll pay quarter 1 and 3, and you'll pay quarter 4 and 2, or I'll pay all of them, or you pay all of them, that's allowed between the parties, okay? What happens if they don't agree? Then it's generally going to be divided half and half. And then for community property, it's definitely half and half. How about the tax refund? That's something we always need to consider. Get that written down into your settlement agreement. So we don't want that. Anything that's silent in the settlement agreement, as you guys all know, is open for attack later on. I should mention too, as a note, that the IRS considers taxes material. And there are some cases where when the settlement agreement didn't negotiate or mentioned taxes, that it was thrown out because all the material facts weren't established. So tax refunds, they can be allocated as the parties agree, as I mentioned. The IRS doesn't necessarily have to recognize that, but they generally would. But they have the right to allocate it to whom they see is appropriate. Okay, but if it came to one spouse, if it was in the 1 year and they gave that money to the other spouse, you'd still be under the non-recognition rule. So important. How about, this is the last one. I know we're covering a lot of deep stuff and I apologize for that, but tax carry forwards, very important. There are these future tax benefits that many taxpayers have, and you don't want to forget about those. You want to get them in your settlement agreement. And the first one is your capital loss carry forwards. They're generally allocated depending on the spouse that triggered that loss. Okay, and so those carry forwards, they should be allocated over to that spouse. That's an important rule. How about when they make joint charitable gifts and they want to get their charitable deduction? Well, that should be allocated between the spouse that really gave the money. But say they had tenants by the entirety's house, they sold that house or they donated that house together, then you should allocate those charitable contributions between the parties in that same manner. Net operating losses, those should be allocated in proportion to the spouse as though they filed separately. How about losses from an S corp? Well, that should follow the stock in the divorce. And then right now, general business credit carry forwards, they're suspended under the Tax Cut and Jobs Act rule, but those should also follow along with where your property or your business interests are going to go. So don't forget your carry forwards, get them down and put them in your settlement agreement. Some other income and deductions, allocations, housing costs. Remember, there's no deduction for improving your house or repairs or maintenance under 263A. So I mentioned that you can't allocate them. They just are what they are. But mortgage interest. What about mortgage interest on the primary residence? We all know that that's deductible. Remember that our standard deduction is doubled on the Tax Cut and Jobs Act, so about $25,000 per married couple. So unless they're exceeding the $25,000 and filing itemized, this isn't really coming into play. But let's say they have a gigantic house. Still probably wouldn't matter because you can only get up to $750,000 of interest deduction. So they might not, but the important thing for you to understand is that under 163, it used to be that you could allocate the qualified residential interest to the party that was paying it. But the rule was changed slightly and we don't have final regs on it. So I guess I would say to you, go ahead and allocate it to the person that's paying it, but get it in the settlement agreement. Some people feel like the person that's living in the house, if they're paying the mortgage, they should be the one that gets the interest deduction. Some spouses feel like, well, I'm paying the mortgage while my spouse lives in that house, I should get the deduction. So again, if the parties can agree to it, get it in the settlement agreement. Property taxes, it used to be that we get a deduction for our property taxes. They call them state and local taxes or SALT. But those were also diminished significantly. There's a $10,000 cap on them under Tax Cut and Jobs Act. It expires again in 2025. But make sure you're allocating on your settlement agreement who's getting the deduction for the SALT. Tenants in common. If you have tenants in common issues, really you need to deduct only up to the extent of the ownership interest or the losses and the gains. Okay, so that's just a general rule to start from. Dependency exemptions. Now we're talking about child-related tax credits. I'm not going to go, this is a slide I made for you so you can take a look at it, but the dependency exemption is gone under the Tax Cut and Jobs Act. They actually didn't remove it from the code. They just reduced it to $0. So not important really to look at that until after 2025. Here are some current child tax credits. The earned income credit, or we call the ETIC, the child care credit, and the head of household. Those are usually going to be given or should be allocated to the custodial parent. That makes sense. If the one parent is taking care of the children 90% of the time, why should the non-custodial parent get those? Again, it can be negotiated. The IRS doesn't have to be bound by it, but it always seems equitable that the custodial parent will get those, okay? And that's what I say here again. The child tax credit, it's $2,000 to $3,600 per child under 6, and it goes to $3,000 for qualified children under 18. So it's significant. It's a significant credit. Here's another thing that a lot of us don't consider, but I think we all know that we're under the ACA, or the American Care Act, or the Affordable Care Act, excuse me. And remember how if we didn't get that form each year, we're going to get taxed? Well, if the custodial parent doesn't have health insurance for their dependent child and they get taxed for that, there's a penalty that will get allocated to the custodial parent. So make sure that you think about that in your settlement. If who's paying the health insurance, if that spouse is responsible and he's not keeping that health insurance, as we all know happens, the agreement should say that he'll be allocated the tax burden of that. Cancellation of debt. We're about to take another break. I hope everybody's doing okay. This one's so important, so important. They call it COD income. And COD income is if I get a credit card for $25,000 with the Amex, and then I say I'm not going to pay it anymore, and I don't file bankruptcy, and Amex tries to collect on me, and they try to collect on me, and they can't, and they decide to discharge the debt, they can do what's called a 1099-C, and they can cancel the debt and say, Peter, you don't owe $25,000 to us anymore. And I'm like, wow, that's great. Good news for me for not paying. The bad news is that when they issued me the 1099-C, cancellation of debt income, they also send it to the IRS, and the IRS says, Peter, you have just earned $25,000 in ordinary income. So although I got out of the debt, now I owe ordinary income on that $25,000. And if I made a lot of money, I might be at the 37% tax bracket. It's still less than the 25% that I would have owed, but it is something you must be concerned about when you're negotiating with business partners or with spouses, that if there's some kind of unknown debt that could be canceled, you better have that provided for in your settlement agreement. The creditor doesn't know what your settlement agreement states, okay? So we must think about cancellation of debt income. And the taxpayer, they're obligated to report it as ordinary income in the year of cancellation. Okay, so you should build in your settlement agreements that, hey, if there's debt canceled on this, when you assign the Amex bill over to that spouse and he doesn't pay it, and then your client or one of the parties to the mediation, they get 1099, it should already be in the settlement agreement, and they can go after that spouse for not paying it. There's, of course, exceptions to cancellation of debt income. The big one for you to remember is insolvency. If the client's insolvent, they can use that exception to not have cancellation of debt income on their 1040. Bankruptcy is another one. If the creditor, or let's say it's the parent, cancels the debt on the child, they could just say, hey, it was a gift. And so there are some. Qualified farm indebtedness is another. Okay. Whew, that's a lot. We're getting so close. I don't think we're going to make through all of our material, but we'll try.
This is fantastic, Peters. Thank you so much.
You got it, Ann. Glad you're still awake. As we get into retirement, it gets a little complicated. I'll go over to some simple rules, but it reminds me of Confucius, who tells us that life is very simple. It's us that make it so damn complicated. Retirement plans. We all know that there's these various retirement plans, but basically they break into, there's a 401k, which is run by your employer. There's a 408, which is your IRA, which is not run by an employer. And then you have your 403b and your 457b. They're a government plan. You'll see those through schools and large, nonprofit institutions. The first rule to remember, when we're negotiating whether that 50% or 70% of the IRA should go to the spouse, first, we're again under non-recognition rule to transfer that 75% of the IRA over to the spouse. However, you should do that in one big lump sum. So let's just go with a $100,000 IRA. We negotiated that the spouse should get 70% of that, $70,000. Don't give it to her in a $20,000 tranche, and then a $20,000 tranche, and then a $30,000 tranche. It needs to be done in lump sum. If you do it over tranches, the IRS might say, you know what? This isn't really qualifying under the rules of 72, and we're going to call it, it's taxable to you. Okay. So one lump sum, move it all over at one time. IRAs, you find that rule that a transfer of an IRA interest from one spouse to another pursuant to a divorce decree, tax-free. There's your rule. It's 408D6. Couple other rules on that. I think we know when we get a distribution from a qualified plan or an IRA, it's ordinary income in the year of distribution. So if I have $100,000 in cash and I have $100,000 in IRA, which one would my client rather have? Do they want the IRA that when they get, it comes out as ordinary income, so they're really only netting $70,000? Or do they want that cash where there's no tax associated with it and they put in their pocket $100,000? So keep in mind that these are not equal assets, and we need to figure out what the net value of these assets are and how that could apply. 2, on 72T, it imposes this 10% penalty if you pull money out of that account under general rules. There's exceptions. If you're under 59 and a half, you're paying it, but if you're greater than 59, you're not. If it's for death or disability, medical expenses, a quadro that you guys all know of, first-time home purchases. But you know, if you're giving that client that that $100,000 IRA, not only is it ordinary income, but also there's a 10% withholding. So think about those as you work through your negotiation. Again, remember, if you get a quadro on an IR or on a qualified plan, you can avoid that 10% rule. Quadros only apply to qualified plans for employer plans under ERISA rules, under federal rules. They don't qualify for IRA. So you're never going to get a quadro for an IRA. Okay. Any amount that's paid or distributed from an IRA, it's going to be included in the distributee's gross income. Okay. So when you're giving that plan over to that spouse, again, it's ordinary income to them. So think about that. There's exceptions when the transfer of an IRA is incident to a divorce or a signed separation agreement. It's not taxable at the time of the transfer, okay, of the IRA interest. And what does that mean? Well, let's look at this little case called Jones versus Commissioner. And what Jones did was Jones got a divorce and he thought he was going to be so tricky. He had this IRA and he was ordered it to give it to his wife. And what he did was, he cashed out the IRA. Let's say it's $100,000. He called his bank and he said, give me a $100,000 check. They gave him the $100,000 check and he endorses it and gives it to his spouse. And he tries to say two arguments. One, listen, I transferred the IRA. That should be a non-recognition event. The IRS says, no, you have pulled it out of the IRA vehicle and put it in your own pocket. So now it is no longer not taxable as a qualified plan. 2, you're not able to allocate that tax deficiency over to your spouse. You put it in your pocket. You're on the hook for that. So when we're going to do a transfer of a qualified plan or an IRA, I'm going to show you some rules. We don't want the client to take the money out of the qualified plan and then give it to somebody. It's going to trigger the gain. And really what we want to do is we want to do trustee to trustee transfers. So for an IRA, for example, if you're going to give it to the spouse, you just call the institution and they'll retitle the account in the name of the spouse. Or if your spouse wants to bring those funds from bank institution 1 of spouse A over to their bank institution 2 to spouse B, they could do a trustee to trustee transfer. Just don't allow the money to come out of the account and then try to put it back in. That's not going to work. If it is an employer plan, there's a direct rollover option where the other spouse can just directly roll it over into their account. If you have a plan into an IRA, then you're doing the direct rollover from the plan to the IRA. Then you're in the trustee to trustee transfer once you're into the new IRA, like you are number 1. And what about an IRA into an employer plan? That's done by the direct rollover, okay? So very important how you make those happen. The Unemployment Compensation Amendment said in 1992, it said, hey, you really need to allow taxpayers to have this direct rollover option. And so they made that a rule. But they're on a qualified plan, like a 401k, it imposes a mandatory 20% withholding when you're going to roll it over. Okay, it's important to keep that in mind. There's a 20% mandatory withholding. If the plan participant, they can avoid that if they do a direct rollover into an eligible retirement account. But if they don't, it's mandatory 20%. That's different than the IRA rule. There is no mandatory withholding if you want to cash out the IRA rule. Oftentimes you'll see they'll say, we'd like you to withhold 10%, but you don't have to do that. So the rule is 401ks, you got to withhold 20%, IRAs, you don't. I want to cover the 60-day rule just really quickly. We're going to cover two more quick topics. This is an important one for you to understand. Say your client doesn't have any money. All she has is a qualified plan where they allow the 60-day rollover rule, where they can basically take money out of their account for 60 days and put it back in that account and not get taxed on it. Well, what about Jones, Peter? You just said the guy pulled it out. Yeah, he pulled it out of his and he tried to give it to her to put in a different one. It doesn't work. You got to put it back in yours. But if you pull it out, if you pull money out and you get it back in 60 days, before 60 days, no tax ramifications to you. So it's kind of like loaning it to yourself. But if you miss the date, if you go longer than that, you're going to be subject to the 10% rule. You're going to be subject probably to ordinary income. And if you rolled it back in on the 61 day, there's some relief to those. You might be subject to excess contribution rule too. So if you're going to do this loan, know the rules, get it back in within 60 days. A couple things. If you're late, the IRS, there's so many late returns. They were just like, gosh, we can't take any more. They're just going to allow you to self-certify. A CPA will help you with that. You can go get a private letter ruling if you want, but basically you can self-certify to say, hey, I got sick. It was 65 days. Please don't hold me against that. When does it start? When the owner gets the check in their hand. Okay, so as soon as they get the check, that's when the 60 days runs. They do what they need to do and hopefully can get that money back in there. Lastly, I want you to know you can only do it once a year. Okay, even if you have multiple IRAs, you can't do one per IRA per year. You can only do one per taxpayer per year. All right, sale of primary residence. I think we will cover this topic and then we'll stop. Sale of primary residence. I think we all know that we have this exception of $250,000 for capital gain for the primary residence. And if we're married filing jointly, $500,000. Couple rules on this. You can only use this exception once every 2 years. There's a couple of things. First, what's a residence? Well, it can really be almost anything. The rule is it just must have a bathroom, a place to eat, and sleeping. So it can be an RV, for instance. If you have multiple homes, you really need to determine which one is the primary residence for this exception. Mostly it's going to be where the taxpayers have put on their tax return. But all of these things are where the bank or the IRS will look at. If you get audited, they'll want to find out if that really is your primary residence. Let's say it is your primary residence. There's two rules. There's the eligibility. You have to be an ownership rule and a residence rule. The ownership is you must own the property for the last 24 months out of the last 5 years. And the residency requirement is you have to use it as your primary residence for at least 24 of the last 5 years, 24 months of the last 5 years. It doesn't have to be consecutive. You didn't have to live there for 2 years in a row. You can live there 1 month on, 1 month off. It just needs to accumulate to 24 months. Okay. And what happens if we get divorced? Again, if you're filing before the decree is entered and you're filing jointly and you sell that house during the divorce process, you're filing joint, married, jointly, you're getting your 500 exemption. The ownership test, when they're filing jointly, only one spouse needs to meet the ownership test. And for the residence test, when you're filing the joint return, both spouses must meet that test. But the rule is different, as we'll see in just a second. Neither spouse could have used this in the last 2 years, but now when we see that we're getting divorced, the taxpayer who moves out of the marital residence, but can continue to count the time that the one that's living in the residence was ordered to live in there. So although they're kicked out of the house, they can still use, if they get the gain, they can still use their residency 2 year to apply for their $250,000 exemption. Okay. If one spouse transfers the residence to the other spouse per the divorce decree, The receiving spouse is entitled to include the transferring spouse's ownership period in computing their own ownership. So say I get married and I move the spouse into my house for 1 day and we get divorced. She's only lived there 1 day, but I lived there more than 2 years. She gets the residency rule, okay? Lastly, I want to mention that the taxes follow the title. If I own property with a partner and that property is owned 70-30 and another property is owned 50-50 and another one's 10-90, you should really be allocating the tax gains and losses pursuant to the ownership interests. Can we cover the last couple of things? Maybe. Partnership rule. I just want you to know that there's this 7-year rule. Generally, when a partner puts money into an account, if he takes that same amount out, it's not taxable to him. But there's a 7-year rule that I want you to take a look at. When a partner puts in an asset, it contributes an asset into a partnership. If they wait longer than 7 years, that same asset can be distributed to other partners without tax ramifications. But if I put an interest in a property within the 7 years and I give it to someone else, it's going to be a taxable event. Lastly, we'll just look at losses that I put here. I want you to know that the partnership can only recognize, the partner can only recognize the losses which is connected to their partnership interest that really associated to their risk of loss. So if they have a 10% partnership interest, they really can only be allocated 10% of the losses. I think we're going to stop there and take a break. And I guess we'll open it up for questions. I hope there are none. And with that, I'll say thank you.
Thank you, Peter. I did ask that if anyone has a question to put in the chat, but I suspect everyone is so stunned by the incredible wealth of information that you gave that they're all sitting there going, oh man, I don't even know what to ask. There's so much stuff here. So you are an absolutely remarkable speaker. Thank you for what you did. Whoop, wait, might be someone in here. Oh, Magistrate Bocelli, sorry, says very comprehensive. Thank you, Peter. So that's a nice compliment.
Yes, so nice.
A couple folks.
We really appreciate it. And we did apply for CLE. We're sorry we're a little late on it, but we'll get it out to everyone. Thank you.
And you did get a couple of remarks in the chat about people who had to leave because they have court obligations, but they will definitely watch your presentation on YouTube. So I don't think anyone left for any reason other than that. And I am just totally blown away. You set the bar really high here, Peter, for the rest of our speakers this year. And the speakers, if anyone has not had an opportunity to check out Peter's section with real property probates, but not elder law.
No, not elder.
Okay. Please do, because his speakers are excellent, and he does a great job in coordinating all that, along with Kenny is still your co-chair.
Yes.
Kenny Kemp, yeah. So in any event, at this point, we're going to go ahead and wrap up. Our next speaker will be in August, and it's demystifying the mediation caucus, and I think it's going to be a lot of fun. And Peter, once again, thank you so much, and appreciate your time. And we will catch you another day in your own presentation CLEs. So
thanks, Ann.
thank
Such
you.
a pleasure. Take care. Bye-bye.
Okay. So I think, Lauren, we are concluded for today. Thank you.